it's really, really essential that to really get a handle on the psychology part of trading and the risk management. How important it is? I mean, it's very crucial because this is basically without capital, you cannot play. It's like you're trying to play soccer without a ball. You have to have the ball to play. So, and the market can be volatile at times. And if you don't know how to adjust your position sizing, which you're going to dive in the next few slides, if you don't know how to adjust your position sizing, you're going to lose long term. You may win today, you may double your account today, then the next day you may just blow it all up again. This is all things that I've experienced.
Right.
I'm just being transparent. This is everything I'm talking about here is nothing like I read in the book. Yeah, I've read it in the book too, but when you go through it, there's another level of understanding. Okay, that's another level of understanding. So that's what I'm talking about. I'm talking about real life experience. There's no substitute for it. You can read it in the book, go to seminar, webinar, but when you go to it and put real money on the line, because a lot of times people can be successful trading in the same account because there's nothing on the line, but this is where you need to manage your emotions. There's something on the line. And risk manager will help you keep your psychology in check, because if you're not trying to hit a home run every time or just go big or go home kind of mentality, it's going to keep you longer in the game. It's very, it's really a game of survival, when it comes to trading. Because if you don't have capital to trade tomorrow, it's pointless. You got to have capital to trade tomorrow. So how do you get to that point where you can manage your risk? There's a few ways. Stop loss. You got to put a stop loss in the market. The stop loss order is basically saying, hey, I have an analysis. I think this market is gonna go higher and higher and higher, and I buy right here, and my stop loss should be below the swing. That's something we're gonna go. And this is the amount of room I give the trade to either prove me right or wrong, and my target could be up here. Let's say the market start going my way, almost to my target, and I've moved it to break even, it comes back, now I don't lose any money. Or if the market immediately goes tank on me, the market just tanks on me, right? So I have this to protect me. This here was going to say, hey, broker, take this guy out. He doesn't want to lose any more money. It's very, very important to do that. And a lot of times people don't use stop loss. And once again, it's really an ego thing. They want to be right. They want to be right. They don't want to be proven wrong. There's no ego. Oh, there shouldn't be any ego in trading. Because you want to limit your loss. That's what the stop loss is for, to limit your loss. Position sizing, very, very important. You don't want to trade too big. Because if you trade too big, that means your stop loss is going to have to be tighter. That means you're not going to leave enough room for the market to give you a chance to be right, to get to your objective. Because if I enter here and I put my stop loss tight and I trade 2 contracts, okay, that's 2 contracts right here, 2 contracts. But if I enter the same place and I put my stop down here, I can trade 1 contract. I give myself more room to be able to, this is a riskier trade, even though you have potential to make more money here because you're trading 2 contracts, but this is riskier. This you give it more room, it's the entry. I gotta get a pen. So definitely you want to be able to know that the position sizing is very, very important. Very, very important. So now let's go to the next slide. Another way to manage your risk is to diversify. I think we touched on that the other day. You don't want to be trading just one type of contract. Some people say, hey, the only contract I'm going to trade is the ES. You can. Some people can just be a specialist. That's fine. Okay, I'm just going to trade the ES. That's fine. But you got to know when not to trade it. And most traders are not trained to not trade at all. They're going to always say, okay, this is going to be the same, this pattern here. But there's some days the ES is definitely something you want to avoid. Look at CL, to crude oil, look at gold. Usually what I say to people, get one metal, which is gold. Okay. Then one energy, which is crude oil. And then you can have 2 or 3 equities. Yeah, so NQ, I wouldn't touch it now, but you can probably trade the YM. It's a little less crazy, or even the Russell, RTY, the Russell 2000 futures. These 3 you can start trading. Honestly, if I were to start trading, I'd probably even stay away from the ES because you got $12 a tick. But also the ES move a little less than those guys as far as points. So the ES today, I think it's less than 20 points today. Last time I checked, it was less than 20 points. So meaning, let me do another color. Meaning, I think the RTY definitely was 20 points. That's about 80 ticks, right? On this. The RTY definitely one leg I looked at it was more than 100 ticks. Those you can trade because they got you $5 tick. And also you can trade the ES, but trade the MES. All right, let me just write it down here. MES, which is a tenth. MES is $1.25 a tick. So instead of saying the full contract, you can trade maybe 5 MES, which at that time would be, or 4 MES. You know, at that time would be 4 times that would be $5. $5 a tick. Here, like the Nasdaq, or I mean, we're not going to say the Nasdaq at the beginning, but like the Nasdaq YM and RTY, because you got to manage your risk. So you want to diversify as much as you can. You don't want to trying to trade everything at the same time either. But you got to know how to trade them and the nature of them before you jump in, because each instrument has, I would say, a character. It's like you have 5 different kids. If you have 5 kids, they have 5 different characters, demeanors, and things like that. Everybody's different. So that's because people trade those things. Those things takes in the character of the people that trade them. If you're a patient trader, hey, yeah, we can definitely trade the ES because the ES is going to do this, and ES is going to time and go up. But if you're not patient, the NQ, it's going to be boom, 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 like this, So you gotta know which one. That's why trying different instruments also will reveal to you what kind of trader you are. Are you more like somebody that don't like action, or somebody that can be patient, somebody that can? So when you try those things, it helps you. And also another category we talked about, metal, indices, energy, and financial. Financial would be like bonds. Now, if you want to learn how to be patient, this is what you want to trade, because this thing might stay in a 3-4 pip range for the whole 2-3 hour, especially overnight. Overnight, bonds gonna definitely, I like to trade the ZB, the 30-year bonds, because it's 31.25 a tick. It's really big as far as the amount per tick. But your stops, if you know what you're doing, your stops should not be more than 8 ticks. 8 tick stops max. Okay, so that means 8 tick stops, meaning $250 per contract. That's the max I'm gonna risk with this. And sometimes if you got a good entry, and especially you can have an emergency stop, meaning you want when you enter the market, you put the stop, but as long as the market move my way 2 or 3 ticks, I'm gonna move it down, and so we can reduce risk. So a lot of times I got ZB trades, and my stop is 5 or 6 ticks, or even 4 within a couple of minutes. Depends if the market move quickly for me, and then I manage it that way. We talk about trade management later, but that's the 4 categories you want to look at and see, okay, which one I want to trade. Now bonds, they have 10 to 10-year also, which is a less amount for the tick size. So all those things, you got to look at them for you, because this is going to be a personal decision that you have to make. You have to be comfortable with, because ultimately you're going to be responsible for your success or failure. And that's another thing with trading. After a while, we go up in the world now. People go up in the world, especially nowadays. People don't want to take responsibility for anything. It was never their fault. You may not have mean it, but it was your fault. But it's really important that we know, hey, what kind of trader, what kind of personality that I have can be, and also your time frame. Because some people, you can watch your charts all day. Some people say, hey, I only have an hour to trade. If you only have an hour to trade, don't try to trade ZB, unless you're gonna go for just a few ticks, 4 or 5 ticks, and you trade at the right time of day too. That's another thing that's important. Knowing when to trade certain things. That's very, very important. Risk reward. Oh, this is really huge. Because most people, they're gonna look at percentage of trade that winning. Nah, this is really not important. What's important is the size. It's like, let me go back to this. Let me undo this. It's the winners need to be way, way bigger than the losers. That's how you win in trading. This is important. Win percentage is very, very overrated. Especially win percentage are pushed with people that are scalping. They're trying to make 4 ticks and risking 20. That's bad. Because eventually you're gonna blow up. Risk reward. So if every time, let's say I have a strategy that's 50%, which is a good place to be. It doesn't have to be 80 or 90% like you see on YouTube and everybody flaunting those things. No, 50%. Every time you win, you take 10 trades. Every time you win, after 10 trades, you make $2 every time you win. All right. Every time you win, you make $2. So that's times 5. That's $10. Every time you lose $1 times 5. So you lose $5. And then now after 10 trades, you have plus 5. Okay? Plus $5. That's a good way to trade. Now, can you actually dictate your risk reward every time? No, you can't dictate nothing. But if the trade doesn't meet the criteria, let's say I'm trading. Let me go back to this and clear, because that's important to understand. Let's say my system said my entry should be here, so I'm going short, okay? Because it's red, I'm saying I'm going short. My entry is here, but my stop needs to be up here to make sense, because you got to give it room. But there's a support level right here, so my target needs to be before the support. That doesn't make any sense. So this is my risk, how big it is, and this is my reward. Reward is very small here. So how you want to trade is, you want to trade most of the time at least 1-to-1. If I'm gonna risk $10, I'd like to at least make $10. Again, you're not gonna dictate that to the market. The market will tell you what is likely. You're just gonna go what's likely. So here, technically, I need to put my stop here because everything here, the resistance really, I want to hide my stop behind resistance, on top of resistance if I'm going short. So the support here, I got to take my top profit target here. So this doesn't make any sense. The way you want to trade is the other way. I'm going to take a long example. Actually, I'm going to do a short example, but I'm going to do it in green. You see the difference. So let's say markets say, hey, you got to go short here. That's my entry. And the resistance is right here. So I'm just going to put my stop right here. Support, the next really significant support is right here. So I'm going to put my target here. I'm going to take profit, TP. That's my stop loss. It's my entry. Now, this is my risk. This is my reward. Really bigger, So you want to keep some trades. You may have it set up, but the trade doesn't meet your risk reward ratio criteria. Everybody had to be comfortable with that. Some people will not take a trade until it's 2-to-1 in their mind. But the 2-to-1 is something that's in your mind because until you hit that target, you don't know. So at least you have the potential. Or we're not trading in possibility. Everything is possible in trading, but not everything is probable. So you want to trade what's more probable. If there's a support here, your profit target should be before the support if you're going short, and vice versa. If you go long, let's say you buy here, it's your entry. Stop loss is over here because there's a support. That's right here. So there's a resistance here. So my target should be a little before the resistance. Now I got this much for reward going long. I got this much for risk. If I go short, this is what I'm risking of losing. And also, before you enter a trade, now I used to do that. I'm looking at how much can I make? No, how much can I lose? That's the first question you got to ask. If you cannot afford to lose that much, there's two things. Either you're gonna have to, let's say you are trading one contract, you didn't have any. Wow, I think I logged it into the wrong account because it's saying my meeting. I have two Zoom accounts, one paid one and one not paid. Right. So I got 8 minutes left. So I'm gonna wrap this up in 8 minutes, and we can finish the conversation on the other side. Okay? Yeah, I'm gonna log back in and send you another link because I'd like to finish that. But anyway, so I'm gonna. So basically, you want to definitely your reward more often than not to be bigger than your risk. That's the bottom line. You cannot control your reward, but you can control your risk every time. Psychology and emotions. Emotions, really controlling them. First of all, emotions, it's not like something you can't get away from. People say, "Oh yeah, I don't want to feel nothing." No, you can trade. People that are teaching emotionless trading, they don't get it. We are emotional beings. Emotion is going to happen. There's no if or but about it. It's going to happen. It's a matter of how we react to it, how we control it, and part of it is really how we manage our risk. Because if we risk too much, we're going to be fearful. That means there was some greed in there. And being patient is definitely a virtue when it comes to trading. When you hear patience to virtue, when it comes to trading, that's real true. Because that's going to make the difference between a winning trade and a losing trade. Sometimes people don't want to wait for the market to show its hand. So you want to do that. So some things to manage that. Again, a trading journal. Last night I was up for the European session. So I have a big 3-subject notebook, and I've not even finished my journaling for today, but it's about page and a half so far. I have to have at least another half a page to fill. So you got to definitely talk about, write down your emotion, write down about the reason you took the trades and how it's going, or you can even journal mid-trade. I was doing that as the trade was progressing. And when the trade finished, you want to definitely, talk about what you learned and what you can do better, what you could have done better, and the lesson learned for next time. And sticking with your trading plan is very, very important because today could have been a much bigger trading day, but it's Monday. Mondays are really hard to trade because the analogy I make usually on Mondays for any kind of trading, whether Forex, any instrument, Forex or stocks or futures, it's like a plane. Imagine a plane taking off, but the best way they're going from Boston to LA. So the direction should be west. But based on the weather conditions and the way the runway is, they got to fly east and then turn around. So usually that's what the market does. And on Mondays, kind of set up the environment for what may come. And sometimes Mondays, it's a fake out day. They could be positive and the whole week is negative, and vice versa. Or Monday could be positive and the whole week is positive too. Or Monday can be negative and the whole week is negative. So you don't know. Stick with your trading plan. Just know that there's going to be some bumps. It's like navigating a road. There's going to be bumps, things that you didn't know, but really try to not make your decision based just on emotions. The decision needs to be based on sound rational. That's why it's good to look at the market when you're not in a trading. I'm not going to be trading right now. I'm just looking to see, okay, what may come, before we go to bed. Or for me, sometime at night, I look at the overnight session to see, okay, what may come the next day. And if there's something in, I trade the overnight sometimes. It's, very small. The movements are not as big, so you can definitely control your risk a little better because the volatility can be a killer if you don't control your risk. Accepting those losses, you can accept them. That's part of trading. I'll give you an example. last night, before I took the long on the YM, I was short the YM on a different account, but it wasn't moving much. So I was fortunate enough that I got out at break even, realizing after I entered the trade, after some minutes went by, I'm like, this trade doesn't look like, when I'm looking at the volume and everything else, I'm like, this trade looks like it's gonna go higher. So let me just get out for one tick profit, and I did. And then I waited for later on to get the better entry going along. So patience and discipline is very, very important. You gotta wait for the high probability. It's all about probabilities in trading. You want the high probability setups. If the dailies, if the, we're trading, the daily chart is negative. The 4-hour chart is negative. Hourly chart is going down. The 30 minute is going down. So if you're a day trader like me, where you look at five 10 minutes to enter your trade. So most likely you want to look for short opportunities, not long. Unless you really know what you're doing, you're just timing things where you go on the support and you buy a little pullback and get out real quick, which I don't like to do that because you don't know when this market's going to be plunging again. So you want to definitely be patient and stick to your plans. Volatility can definitely be something that make you or break you. On a good day, if you're on the right side, you can definitely make a lot of money. But if you're on the wrong side and don't know when to get out of the trade, because a lot of times people, instead of volatility, is the stubbornness of not getting out, want to be wrong, want to be right. Futures can definitely, and especially news, yeah, you don't want to be trading. You got to definitely adjust your size accordingly. If it's a news day, trade smaller size because you're going to have bigger stops. And how you determine your stops? Use ATR, what we talked about. Bollinger Bands is another way to look at volatility. So I'm going to do some on screen and show you those because, again, we're about a minute and a half here. I'm just trying to finish the lecture part of this. And we can go. Adjusting your strategies is important. If it's a ranging environment, you don't want to be going for big targets. You want to definitely go for a ranging strategy, bad support, sell resistance. Don't expect there's going to be breakouts. And, the market's sometimes going to trade in the box. And when you trade in that box, you just do what it does, Hey, that's the box. You buy here, you sell right here. You buy here, sell out here. The market's going to do that, in that box. That's the environment that we're in. But if it's trending, hey, you can definitely time your entries. And if it's going up or if it's going down, you time it accordingly the same way. So you definitely need to understand that. Learning, you got to adapt and continue to learn. So that goes without saying. You can just read this chart when you would look at this whole recording. You got to evaluate the strategies continuously. Having a support system is important. Having people that support you, family members, or somebody that you can trust, a mentor, like we're doing here. So it's very, very important to be around people and have a balanced life. A lot of life cannot all be about trading, and at one point it was for me, but I learned that the hard way. So gotta take breaks and prioritize self-care. It's important to do that. Next week we're gonna talk about. Next lesson we're gonna talk about technical analysis and some more strategy.